So if you live in a country with a government that racks up debt on your behalf, then you're going to want to listen to this. But first, here's the problem you need to understand before we can talk about why you should care and what to do about it. So you have to understand the government has an incentive to slip some inflation by you. And the reason is quite simple, it's that they have a serious debt problem. Now what you have to understand is the government has two ways to deal with a massive, unsustainable debt load. Now, for all intents and purposes, you can think of this government balance sheet or this government debt problem just like a personal balance sheet that's essentially out of control.
I don't want to answer your question about the recession.
Okay, welcome back. So imagine you're servicing your debt with interest-only payments. Your income isn't high enough to pay that debt down or pay more than the interest only. You're just essentially on a financial treadmill where you can't get off. You're a slave to that debt. And so you might be surprised to find that a lot of governments around the world are in this situation right now. So back to the two ways that the government can deal with their debt problem. Well, the first is they raise taxes, and that's going to be very unpopular with the voter base. You're not going to like it, I'm not going to like it, nobody's going to like it. And it's a traditional way to raise revenue as a government. You raise taxes, and then you have more revenue to service your debt with. And worse yet, what that means is that previous generations didn't pay their fair share of taxes to actually support, their social services and their pension deficits. And so there's actually a generational inequality issue here as well. So suffice to say, the government's political opponents will slaughter them if they did this in any meaningful way. Even if it was the fiscally responsible thing to do, they just won't get reelected. So you can bet policymakers are sitting around discussing this and they're not keen on it. They're not keen on it and they're looking for alternatives. Well, there's only one that has been used and will continue to be used, and that is to allow the value of their currency and the value of their debt to be worth less in the future. Okay, let's run through an extreme example to help illustrate how this would work. And this is important, so stick with me on this, okay? Let's say I borrow $1 million from you, denominated in my own currency, which I happen to manage, called Blind Pilot Dollars. Blind Pilot's my Twitter handle, so that's where that comes from. And you may have noticed the channel is sort of branded in that way, subtly, or not so subtly. So you happen to have, a large stack of these Blind Pilot dollars sitting at home. You want to invest it. And you happily lend me the money in exchange for me paying you some interest on that money. So let's say I pay you, 3% interest. Also paid, that interest is also paid in Blind Pilot dollars each year. Now here's the thing. I can create more money, more or less out of thin air, provided I have a good reason to, because it's my currency. So for example, an economic crisis in my country or my Blind Pilot land here, that necessitates a bit of money printing. We won't dive into that right now, but suffice to say, let's imagine doing so creates some inflation in the economy. We start seeing prices rising. Now, let's imagine that prices rise dramatically due to very high inflation, a lot of money printing or inflation expectations just getting out of control. So let's pretend, for this example, that I'm in the bakery business, and initially, when you lent me the money, I was selling loaves for $10 a piece, okay? You could have bought a lot of loaves for $1 million, obviously. Now let's imagine that the price of inflation has been wildly out of control to the point where a loaf of bread now costs 100,000 crappy Blind Pilot dollars instead of just 10 previously. So it's an extreme example, but for illustrative purposes. So to simplify, let's assume that I make 100% profit selling these loaves of bread, flour is cheap or whatever, I don't know. So now I owe you $1 million, right? I only need to sell 10 loaves of bread to pay you back your $1 million now, because bread's so expensive in this economy that we're living in. So when you get your $1 million back, here's the clincher, the money that I've had for who knows how long, I give it back to you, and now it has the buying power of literally 10 loaves of bread. I mean, ouch, right? Ouch. That hurts. So you can see how inflation has massively benefited me, the borrower, in Blind Pilot land. Spoiler alert for another episode, probably. Those with large mortgages have massively benefited from this trend over the years. Carrying debt has been rewarded, essentially. So You know, in the real world, the government is a massive borrower and arguably, can't reasonably generate enough tax revenue to pay back current and future liabilities, not without pissing off their voter base by raising taxes through the roof. So they're going to see a healthy level of inflation as a nice out given their predicament, right? Given the same sort of dynamics we just illustrated previously. Of course, on a less extreme scale, one would hope. But now here's the other trick. If you owe a ton of money, you're the government in this example, you don't want interest rates to be 10 or 15%, of course, right? You want the best of both worlds. You want low interest rates, and you want inflation to actually be a bit higher than certainly where interest rates are. So you benefit from the differential. So on the other hand, the lender, if you're a rational lender lending to a government, let's say the U.S. government, who you think is likely to try to inflate away your debt or their debt, as we just described, then you're going to want a healthy interest rate, right? Healthy return to compensate you for that risk. You're not going to accept 3% a year with that risk lurking in the background. So, interestingly, the US government has walked a fine line in the past, managing to keep interest rates extremely low, right? We had like 10-year bonds at zero not long ago, right? 0% interest. It almost doesn't even make sense. It was so comical, frankly. I was explaining this to someone the other day, and they're saying, well, why would anyone buy a bond? Why would anyone buy a 10-year bond that pays zero? Well, that's a good question, right? There were trillions, certainly billions, probably trillions of dollars spent on bonds that don't yield anything. So anyway, a bit of a tangent there. So, as I say, the U.S. government has walked this really fine line. They've managed to keep interest rates extremely low despite the risk of inflation. And they have, certainly more recently allowed a healthy amount of inflation to creep into the system. And that's sort of the self-serving incentive, right, that we were discussing. It's like if you can allow that inflation to creep into the system, but not really have people aware of it, then you sort of benefit on both sides. So now here's the other thing. So let's imagine that you, the government, are also the body reporting the inflation numbers, the official inflation numbers within your own country, right? The ones that everyone benchmarks everything off of. Well, aren't you going to have an incentive to report those numbers as low as possible? To soothe concerns among your populace of runaway costs? As well as to assure your lenders that the purchasing power of their money when you return it to them in the future isn't going to be decimated, right? So doesn't that feel like a bit of a conflict of interest? Like I'll tell you what inflation is, while you lend your money to me. Just believe me, right? So yeah, essentially, it's like you lend me money, and then I'll tell you that I'm maintaining the integrity of that money while I hang on to it and use it for as long as I need. So, speaking as the government or thinking as the government, you'd want some inflation to deal with your debt problem. As the government, wouldn't be popular with our citizens if we're causing the prices of goods and services to rise by, say, 10 or 15% a year. That's going to be unpopular. And our lenders are going to demand more interest on our loans too if they think they're going to be paid back in dollars that are worth far less or with far less buying power in the future. So, how do we balance this mismatch in interests? Well, it seems the government has more often than not taken the approach of creating baskets of goods and services that they report inflation on that aren't really representative of true inflation. Let me emphasize, they create a basket of goods that they report inflation on. What items do you think they might exclude or de-weight if given a chance? Steak at your grocery store, probably going to leave that one out, right? Or not weight it in the same proportion as what you might spend on it in your daily life. They're probably going to leave out all sorts of things. I mean, leave me some items in the comments that you think they might be overlooking, because I know there's lots that you're spending on and you're feeling inflation on, where they're just not capturing it properly. So yeah, I'm just curious to know what you've been buying that you feel is more expensive than it used to be. So to reiterate, the inflation that you experience is unlikely to be the same inflation that they report officially, right? They report inflation to you of say 5%, and that's the official number. except when you go about your daily life as a consumer, you experience something closer to like 10 or 15% annually, realistically. There's a good video. Maybe I'll share it. There's a guy going around Costco, and he's basically just showing the difference. I think he happened to have the video on his phone from 2016 to now, and it's like the prices have doubled or whatever it may be, and there was just certainly not the inflation that the government's been reporting, right? So here I found it. Let's take a quick look.
So I'm walking around Costco here, and I'm noticing these prices. For example, these madras lentils, $15.99. I bought those a year ago for $6.99. I keep getting told that we got 6-7% inflation. You got to be kidding me. Let's look at what else we got going on here. We literally bought this chicken broth, $5.69, 2 months ago. Dang, this is the flour we were buying for $5.99 last year.
They essentially tactfully pulled the wool over our eyes, and of their lenders, amazingly, because they're supposed to be relatively sophisticated. So, put less subtly, they're lying to you because it allows them to walk that fine line and obtain the benefit of paying you back in 10 loaves of bread instead of playing fairly, right? So, now that we've, I would say, established the game that's being played, I think you all understand now based on that example, or, likely do. So yeah, let's talk about why it should matter to you and what you could do about it in the second part of this series. So join me in the next clip. Maybe I'll figure out how to put a link or something. I don't know, probably not. But yeah, join me there. And also while we're here, thank you so much to my first 5 subscribers, I think. That's amazing. I don't know how you guys found me. I'm an absolute ghost on here. So congratulations. And yeah, thanks so much for being here. You guys are awesome. Okay, we'll see you in the next episode.